Okay, so we start with financial statement and analysis, or financial statement analysis simply. Before it was called FRA. Okay. First of all, there's going to be 12 readings. On an average, you have two questions each reading on an average. Okay. Because you have around 20 to 25 questions asked in exam with around 11 to 14% of weightage. Expect at least 20 plus questions in exams, and very sizable weightage it has. But many students are scared with FSA. But do you know one thing, that most of the students who've given exam with me, most of them have managed to score 70 plus in FSA. Very few, very few times you get below 70. So FSA, as much as career it sounds, it is not, but it is very lengthy. So in the revision, our objective is to not do too many things. We need to focus on few things which are very relevantly asked. Okay. So here in FSA, only that is relevant is in our notes. See, previously what I used to do is that after the topic, I used to give students marking that this is important, this is important, this is important. Of course, I cannot say officially this is 100% important. That is not fair. Violation of CFA code of conduct. But I had some idea of what is very important. So most of these things, for example, everyone knows that there is definitely going to be a one question on EPS, earnings per share. Am I correct? Right? That is quite logical, because you also have studied and you know where you struggle, and that is definitely asked. EPS question is always there in exam, right? So it's not something that I got insider information, but out of the years of experience. So all those important elements which I found that they were repeatedly being asked, or I understood that they are important, those I have put up in the notes. So we are only going to study that. We are not going to do a lot of things. So you will see uh, not too much things here. So even this is too much, by the way, for many. So this is the only thing that you should do. You should not do extra thing because you've already studied once. Okay. Now let's start with the first reading, Introduction to Financial Statement. This actually was a combination of two readings before. Okay. So first, let me check, is the recording on, because I have a tendency to keep forgetting. Yes. Okay. So let's start with Introduction to Financial Statement. The very first thing is, how do you do financial statement analysis? This is many times asked in exam. Surprisingly, they ask the steps. First of all, imagine you are an equity research analyst. Your job is to analyze a company's data so that you can decide whether to buy, sell. What is the first thing you need to do? You need to be clear with the objective. What are you, why are you doing the analysis? Are you buying the company or selling the company or giving capital to the company? Second, then you need to gather the data. Gather the data means gathering the financial statements. 10K report. We are going to see, yes, 10K means annual filing report in US. Annual reports are audited. Okay. That is 10K report. Now, financial statements. What are the financial statements? Can someone remind me? Income statement, balance sheet, cash flow statement. These everyone knows, right? Then, correct, statement of comprehensive income, right? Which is very uncommon for many. And statement of changes in owner's equity. I'm writing short form because most of you all already know. These are the 5 core financial statements, correct? Once you get that statements, this is raw statement. You need to process the data, which means you need to calculate the ratios. Then you need to analyze the performance and conclude basically whether the performance has improved or not. That is step number 4. And finally, summarize everything in a research report and communicate it to the clients in the easiest manner. That is, report the conclusions and recommendation. This is where you simulate everything and make up a research report. But is this a one-time job? No, every quarterly the companies come up with their performances, every yearly they come up with the performances. So you will have to monitor and update it regularly. This is a 6-step financial statement analysis process. So anyone who tells me that I want to be an analyst, what is going to be my job profile? This is what is going to be your job profile. Okay. Now, two important things: financial reporting and financial statement analysis. Whose job is to report? Reporting is analyst job? No, reporting job is of the company. So under financial reporting, the objective is to provide information about the company's performance. To whom? to current and potential investors and stakeholders, which includes creditors and everyone. Why? Because they are going to make a decision whether to invest in your company or not. So objective of financial reporting is to provide information. But what is the job of financial statement analysis is to use this information in the financial statement and other informations to make your economic decisions. Correct. When I say other resources, guys, what are the other resources? Other resources are footnotes or financial statement notes, management discussion and analysis. Footnotes, remember, is audited. Management discussion and analysis is not. And then there is something called the audit report, which we are going to see it in a moment. Okay, these are the additional resources. Now, every company prepares its financial report based on reporting standards. These reporting standards are two, IFRS and US GAAP. IFRS, International Financial Reporting Standard, and US GAAP, US Generally Accepted Accounting Principle. These reporting standard, I've mentioned here, IFRS and US GAAP. IFRS is a reporting standard set up or made or established by a standard setting body. Standard setting body is a professional organization of accountants and auditors who prepare the financial reporting standards. They make the financial reporting standards. IFRS, which is global, is done by IASB, International Accounting Standard Board. US GAAP, which is relevant to US only, it is done by Financial Accounting Standard Board, FASB. There's also a common accounting standard body called as International Accounting Standards, which is done by International Accounting Standard Board. So instead of we saying IFRS, sometimes you also refer to as saying IAS, International Accounting Standards, right? IFRS for all, US GAAP only for US companies, right? US companies go for US GAAP. Now, standard setting body's job is to prepare or establish the accounting standards. The accounting standards are generally IFRS and US GAAP, but whose job is to ensure that the compliance is done for the accounting standard, which means the companies do conform to the accounting standard. That is the job of regulatory authorities. Regulatory authorities for capital market in US is SEC. In your syllabus, you're going to see Securities and Exchange Commission. Same way, like SEC, you have Financial Conduct Authority in UK, you have ISMA in Europe. In UAE, you have Securities and Commodities Authority, SCA. And globally, there is a union of 90% of the regulation, which is called as IOSCO. Do I have to memorize this? No. All you need to remember in your syllabus is SEC for US. SEC is what you need to remember. FASB and ISB for IFRS and US GAAP is what you need to remember. That's all. Correct? But as I said, IOSCO is a global regulator. It's any regulator's job is to protect the investors because that ensures the markets are fair and only then people will trust in your capital market and they will provide you capital so that the risk is reduced and the cost of capital is low. Correct? Now, in terms of SEC filings, there are several forms that a company, when it registers with US regulator, it has to disclose various filings. Now, in your notes, there might be several filings. What you can see is these filings only, right? 10K is the annual report. 10Q is quarterly report. Which one is audited? Annual report is audited. 10Q is not required to be audited. Quarterly reports are not audited. Form DF14A is used for proxy statement. What is proxy statement? Whenever company goes for vote, then it needs to file proxy statement. What is proxy statement? So if you cannot vote, someone on your behalf can vote. That is called form DF14A. Whenever the company wants to disclose some important event, material, what is the definition of material? Those who've studied ethics will know. Material is any event which affects the company's stock price or your decision to buy or sell. For example, let's say company has a huge year-end party. Is that a material event? Or company trying to acquire another company? That is a material event. Well, of course, that is a material event, buying another company, right? So disclosing of the material event is under form 8K. Some of the disclosures can be mergers and acquisition, changes in management, and so on. Most of the material events also require proxy voting, right? Form 144 is when the company issues securities to qualified institutional buyers or qualified buyers. See, there is also Form S1. There's also one more form, just I'm giving it for your reference. Whenever the company wants to go for IPO, public offering, they have to file Form S1. You want, you can note it down, or it's in your book in many cases. Form S1 is, guys, when the company wants to go for IPO, public offering. But when the company wants to give its shares to certain selected investors, private issuing of the shares, then it is called Form 144. Got it? Yes. And then when the company's insiders buy and sell securities, when the directors and all, when they buy and sell securities, that is called Form 3, 4, and 5. So when the company's directors, chairman, etc., when they buy and sell securities, that is Form 3, 4, 5. Okay. In your book, yes, 10K is not there. 10K, you can write annual report in many cases. And S1 is there, which is when you go for IPO. Clear? I've put your financial statements, which might not be there in your book, but we already discussed. What are the financial statement? Balance sheet, income statement, cash flow, statement of comprehensive income, changes in owner's equity, and then three additional things called the footnotes, management discussion and analysis, and audit reports. About footnotes and MDA, footnote is basically disclosure. It is compulsory. Okay, it's not a choice. It provides information on companies' accounting methods, assumptions, because not all of these things are captured. For example, which depreciation method has been used? I will not know that from the numbers. I'll have to see in the footnotes. One important thing that I want you to highlight in footnote is that footnotes are audited along with the other financial statements, but management discussion and analysis may not be audited. That is simply the commentary of the management about the past performance or some relationship of the company or some risk. For example, they want to make us understand what is the impact of pandemic on the company's business, what is the effect of inflation or war or any off balance sheet obligation, right? What are the judgments that they have considered and all these are discussion opinion of the management, hence they are not audited. In the footnotes there is something called segment reporting. What is segment reporting? For companies like Apple and large companies which run multiple business, I have a question, but can be audited. See, foot management discussion and analysis is includes multiple things. They generally they are not audited. That's why it's written may not be audited. But it's not compulsory. But footnote is compulsory, has to be audited. Understood? Segment reporting. What is segment reporting? It's in the financial statement notes that when the company has multiple lines of operations or multiple businesses in multiple geographies, then it has to report key numbers separately. Key numbers includes what? Revenue, profit, not everything. This is done, and I want you to highlight this number when something contributes 10% of the company's assets, revenue, or income. Let's say a geography of Asia, Europe, they contribute more than 10% of company's assets, revenues, or incomes. Then you have to do a separate segment reporting. Similarly, for companies like Apple, when iPhone, iPad, AirPods, they contribute around 10% of or more of the profits. When company has multiple such products, then it has to do segment reporting. Correct? If you see Apple's 10K report, it has geographical as well as product-based segment reporting. Audit. What is audit? Audit is an independent review of the financial statement. Remember, it's a review. It's not a guarantee or a certification. Auditor's job is to give opinion on the fairness of the financial statement, and they provide something which I've written here, reasonable assurance. Highlight this or write this, reasonable assurance. One thing that I can tell you that it is very high chance being asked in exam is the type of auditor's opinion. Very, very, very high chance of being asked. See, if all the statements are free from material omission or error, everything is perfect, then it's called an unqualified opinion. Unqualified means perfect. Most of the companies desire this. But if there are some exceptions to the accounting principle, then it's called a qualified opinion. If the auditor thinks that things are not properly presented, if there are exceptions, it's qualified. Qualified doesn't mean that there is something, scam. But when the auditor thinks that there is something like a scam, if the statements are not fairly presented or materially non-conforming with the accounting standard, that is called adverse opinion. Most of the companies which end up into the scam, they have adverse opinion. Unfortunately, adverse opinion is issued after the scam comes out. Okay. So qualified opinion, exceptions to the accounting principle. When there is non-conformity, it is adverse opinion. This is the worst thing. And sometimes the auditor is not able to conclude or unable to express an opinion. That is called disclaimer of opinion. Anything apart from unqualified opinion, whether qualified, adverse, or disclaimer, is called modified opinion. Everyone with me? Clear? Yes. Now, in case of US, you also have to publish the key audit matters. Okay, that is also need to be added along with the audit report, where the auditor will give a detailed, review of what it highlights accounting choices that are of greatest significance. And wherever the auditor thinks that there is some judgment which has a big impact, or some estimations which have a substantial impact on the company's performance, the auditor will put up a viewpoint out there. Okay, that is called key audit matters. Choices where the auditors finds challenging or subjective, and which therefore have a significant likelihood of being misstated. So wherever the auditor finds that there is something that I need to discuss in detail about the choices, that report is called key audit matters. You need to remember this is, as per me, this has the highest chance of being asked in exam. That is audit report. Okay. Now, apart from these financial statements, you can also rely on other financial statements, which are not but published by the company, but these are financial information which you get available in the market. Some are given by the company, some are available for free, some are available for paid. For example, issuer source. What is issuer source? The sources that are displayed by the company itself, like earnings call. Companies do an earnings call with the analyst or investors, presentations, press releases, or events. These are resources from the company itself. Okay. Then you have public third-party sources. Generally, public third-party sources are free industry reports, easily available data from government agencies or economic agencies like central bank, industry statistics, social media resources like magazines and all. Free data basically on Google Finance or Yahoo Finance that you get. All of these are public third-party sources. These are important for the analyst to make up their conclusion, right? You cannot just sit in a room and see the financial statement and conclude. Some are paid, like proprietary third party, analyst reports, Bloomberg, or some consultants. Bloomberg, Reuters, Bloomberg. Have you heard about it? The Bloomberg terminal that you have where you sit down and analyze or pull out the data. That is very costly paid data. That is proprietary third party. Okay. I've heard many of the universities here also, or MBA institutes, have Bloomberg terminal. It is very costly. It is compulsory in the fund management, or it's very much essential. So these are proprietary third party. They are paid resources. Then you have proprietary primary research, where you have commissioned the research. For example, companies or those who are, let's say, I'm interested in buying out this company. So I will commission a report. I will hire an agency like Deloitte, KPMG. I'll hire them, or PwC or Ernst and Young, to conclude a report about the company for me and advise me whether I should buy the company or not. These are proprietary primary research. These are companies whose job is to go out and do the due diligence and get the information about the company and study the company and sell it. Basically, they give this service, right? That is called proprietary primary research. Correct? These are the major, this is the basically the introduction of financial statements. Very important from the point of view of understanding the basics. I know there's not going to be too many questions from here, but very important to make a foundation. Let's do some questions from it, everyone, right? Okay. Number one, in addition to the audited financial statements included in a firm's annual report, which of the following sources of information is most likely to contain audited data? Everyone. Footnotes. Footnote is audited, yes or no? Everyone, yes. Compulsory, right? Internal financial statement with SEC or management commentary. Management commentary may not be, right? Correct. Very good, everyone. Next, which of the following is best description of the financial statement analysis framework? Remember the points. Number one is objective, correct? You should state the objective. Second, gather the data, process it, do the ratio analysis, analyze and interpret it, report the conclusion and update. This is perfect, right? So step number one is always clear the objective. Gathering the data is step number one. No. So automatically the answer is A. Everyone with me? Clear? Right? Now, many of you all must be wondering, Kunal, do you think that these type of easy questions come in exam? Honestly, the questions are easy. So don't judge the questions, okay? These are not my homemade questions. These are, trust me, they are not my homemade questions. These type of questions only come in exam. Those who've given the exam, they can, they can join me here to mention that the actual exam doesn't have lengthy questions as CFA Institute has. Unfortunately, CFA Institute questions are so lengthy. In many cases, I have to tell the students, don't do this, because the real exam is not that lengthy questions, except for ethics. I understand for ethics, the questions are in 4 or 5 lines. But trust me, many students come with the opinion that CFA Institute questions are, you know, they have to be done, they have to be done, they have to be done. Well, I'm not denying that they are not important, but all I'm trying to say is that you have to cherry pick. Many of the topics have very great questions in the institute notes. Some of them are not. Some of them are unnecessarily too long and it's a wastage of time in many cases. However, if you do it, it's not an harm, but it should not stress you, because the real exam is not that lengthy questions as what they mention. Okay. But I know saying anything against the institute is something that students will be like, how can you be better than institute? How can you know more than institute? I don't know more than institute, but I'm saying you honestly, you can ask your friends who've given the exam. The CFA Institute questions are so big, but in real exams, the questions are not so big. That's why most of the students who have given level 1 exam, you can ask them, they finish the exam 30 minutes before. Okay, that's the reality. Okay, next. So that's why, on the first day I had texted you that trust God, trust yourself, and trust me. Okay, don't trust any other's opinion unless that opinion has a sample size of minimum sample size to conclude the outcome of the population parameter. What is the minimum sample size? 30. Yes. So unless 30 or more people tell you the same thing, don't rely on them. Got it? Which of the following is an analyst least likely to rely on as objective information to include in the company analysis? Which amount of the information is not reliable? Corporate press release, government agency statistical is very much reliable, and economy of the company's industry on the economy and company's industry. Proxy statement are filed with the SEC disclosure, so they are reliable. What is not reliable? Of course, the press release, and you know how the press is, right? Okay. These days, the least trustworthy people in the world are press. Which of the following statement about financial statement analysis and reporting is least accurate? Least accurate you have to find, okay? Providing information about changes in company's financial position, that is balance sheet. Whenever they say financial position is balance sheet. Is a role of financial reporting correct? Financial reporting's job is to give financial, a company's job is to give financial report like balance sheet. So there's nothing wrong in this. Financial statement analysis focus on the way companies show their financial performance to investors by preparing and presenting financial statements. Guys, preparing and presenting, is that the job of financial statement analysis or reporting? That is the job of reporting, not analysis. Everyone, so this is wrong. B is wrong. Why B is wrong? We are looking for the wrong statement, least likely. Because financial reporting is the job, whose job is to prepare the financial reports? Company, not financial statement analysis. Analyst job is not to prepare. Deciding whether to recommend a company, yes, that is the job of financial statement analysis, but not B. Clear? Everyone? Next. According to IFRS guidance for management's commentary, okay, addressing the company's key relationship is required, recommended, neither recommended, not required. Everyone, please try this. See, management discussion and analysis is opinion of the management. Footnote is compulsory. Management discussion and analysis, whatever the company addresses here, it's not compulsory. It is recommended. It is not required. Footnotes, anything related to footnote is required. Disclosures are required. Management's commentary about a specific thing are not required. They are recommended. Everyone with me on this? Understood? Clear? Any questions, anyone? Got it? This is where we finish the first topic. Clear? Okay.